Hi everyone, my name is Darshini and my student ID is MC250534836. Okay, I will begin by introducing the article that our group selected. The title of the article is The Impact of Working Capital Management on Firm Profitability. The study examined how working capital management affect a company profitability and whether there is an optimal level of working capital that firms should maintain. The article was written by Sorin Gabriel Anton and Enka Elina Efroy Nuchu. Both authors are research in finance and their work focused on corporate finance and financial management. It was published in the Journal of Risk and Financial Management, also known as JRFM, which is peer-reviewed academic journal. This article appears in Volume 14, Issue 1, Article number 9, and it was published to 2021. The publisher is MDPI, which stands for Multidisciplinary Digital Publishing Institute. MDPI is an international publisher that provides open access academic journals, making research freely available to readers around the world. The study was conducted in Poland because the research wanted to understand how working capital management influenced the profitability of Polish listed companies. For the sample, the research collected data from 719 firms listed on the Warsaw Stock Exchange over a 10-year period from 2007 to 2016. Using a large sample and a long study period helps improve the reliability of the research finding. Overall, this article provides a strong foundation for understanding the relationship between working capital management and firm profitability, which my teammate will evaluate in the next section. That's all from me. Thank you so much.
Hi, my name is Marwani from Group 4. Now, I will present the background of the topic and provide an overview of the working capital management concept. Okay, first, let us understand what working capital management is. Working capital is the difference between current assets and current liabilities. Current assets include cash, inventory, and account receivable, while current liabilities include account payable and short-term debt. According to Anton and Niku, effective working capital management means maintaining optimal balance between current assets and current liabilities to ensure both liquidity and profitability. Why this important? Anchorage and College found that efficient working capital management improve profitability by reducing financing costs and then enhancing cash flow. In addition, a PwC report states that better working capital management could unlock 1.3 trillion euro globally, increasing capital investment by 55%. However, the relationship between working capital and profitability is still debated. There are three main perspectives. First, a positive relationship, where higher working capital support business operation and sales. Second, a negative relationship, where excessive working capital increase holding and financing costs. Third, a non-linear relationship, which suggests the optimal level of working capital that maximizes profitability. Beyond this point, additional working capital becomes detrimental as supported by Mahmoud and College, as well as Botas and Anton. Poland was selected for this study because it is an emerging economy that was officially classified a developed market in 2018. Its business environment is dynamic and differs from major markets such as the United States and the United Kingdom. Furthermore, the study period from 2007 to 2016 includes the global financial crisis, making it suitable for analyzing working capital management under different economic conditions. Now, let me briefly explain the three main components of working capital management. Cash management focuses on maintaining sufficient cash while minimizing idle balance. Inventory management aims to balance inventory holding costs with product availability. Account receivable and payable management involves controlling the credit given to customers and the credit received from suppliers. Finally, Anton and Niku use the working capital ratio as the main measurement. It is calculated as inventory plus debtors minus creditors divided by sales. This ratio measures the intensity of working capital investment relative to sales activities as supported by Actas and College, as well as Botot and Anton. That concludes the background an overview section. Okay, the aim of this review is to critically analyze the study conducted by Anton and Nikiu, which investigates the impact of working capital management on firm profitability. This review has 5 main objectives. First, to summarize the research objective, methodology, and key findings. Second, to critically evaluate the strengths, weaknesses, and validity of the study conclusions. Third, to analyze how the findings relate to CO3, which focuses on working capital management and short-term financing decisions. Fourth, to explore the implication of the findings for business practice. Finally, to identify key lessons that can be applied to other developing economies. This review is important for both students and practitioners because it provides valuable insight into the complete relationship between working capital management and firm profitability. Next, I would like to invite my groupmate Anshantini to present the summary of the article in section 3. Thank you.
Hello everyone, now I will present section 6.3, which is the summary of the article. This section covers the research objective, research methodology, and key findings of the study. The first is the research of objectives. The main objectives of this study is to investigate the relationship between working capital management or WCM and firm profitability. The research aimed to determine the optimal level of working capital that maximizes profitability. They also examined whether the relationship between working capital management and profitability non-linear, specifically an invented U-shaped relationship. In addition, the study provides empirical evidence using the Polish listed companies and offers the practical recommendation for the managers to improve the financial performance. Next, the research methodology. The researchers adopted a quantitative researcher's design using secondary financial data obtained from the Amadeus database. The study analyzed 790 non-financial firms listed on the Warsaw Stock Exchange over the period from 2007 to 2016, resulting in 3,043 firm year observations. Working capital management was measured using the working capital ratio is WKCR in short form, which profitability was measured using return on assets ROA and operating return on asset OROA. To ensure the reliable result, the researchers applied ordinary least square OLS, fixed effect FE, and panel corrected standard errors PCSE. They also included control variables such as the cash ratio, debt ratio, firm size, and sales growth to improve the accuracy of the analysis. Finally, the key findings. The study found a significant inverted U-shaped relationship between the working capital management and firm profitability. This means that maintaining a moderate and optimal level of working capital improves liquidity and profitability. However, excessive working capital reduces profitability because too much of money is tied up in current assets, while insufficient working capital may create liquidity problems and disrupt the business operations. Therefore, firms should maintain an optimal level of working capital to achieve a balance between liquidity and profitability. In summary, the study included and concluded that effective working capital management has a direct impact on firm profitability. Financial managers should maintain the right balance between liquidity and profitability to improve the long-term financial improvement for the performance and maximize the shareholder value. Thank you. I will hand over now the presentation to the next presenter for the critical evaluation section.
First, let's look at the strength of the research. One of the main strengths is its large sample size, involving 790 firms.
with 3,043 observations collected over the period from 2007 to 2016. This large data set increases the reliability of the findings. Another strength is the research used multiple methodologies, including ordinary least square, FE, and PCSE, which is a panel corrected standard errors. Since all methods produce consistent results, it increases confidence in the study. The research also performed robustness checks by using an alternative profitability measures and additional control variable, which further strengthen the validity of the result. Finally, the study makes a valuable theoretical contribution by identifying an inverted U-shaped relationship between working capital management and profitability. This means that both too little and too much working capital can reduce a firm's profitability. Next, let's see on the methodologies part, which the study used data from Amadeus database and focus on company listed on the Warsaw Stock Exchange between 2007 and 2016. The main variables include return on asset, the measure profitability, and working capital management. The research also includes several control variables such as debit ratio, cash, and firm size. To analyze the data that applied, the Hausman test was used to determine that the fixed effect model was the most suitable. Overall methodology is appropriate and reliable for panel data analysis. The studies also have several limitations. So those are endogeneity concern, because most advanced techniques such as the generalized method of moment were not used. The study does not consider important microeconomic factors such as GDP growth, inflation, and interest rate, which could influence the firm's performance. So lastly, it ignores several non-financial factors, which include corporate governance, management quality, and CEO incentive, which may also affect profitability. Finally, on the validity of the conclusion, it is well supported by consistent empirical evidence across different statistical methods. However, because the study only examined Polish listed firms during period of 2007 to 2016, and the findings should be generalized with caution. The key practical implication is that companies should aim to maintain an optimal level of working capital rather than simply increasing and decreasing it. Maintaining this balance can help maximize profitability. Thank you.
Hi, I'm Sivarupini Anaperempuan Selvam. Today I will present the last two sections of our article review, which are application to CLO3 and the conclusion. This article helps us understand the importance of working capital management and short-term financing decision. The study explains that businesses should maintain an optimal level of working capital. This means the company should not have too little or too much working capital. If a company has too little working capital, it may face cash flow problems and have difficulty paying its daily expenses. On the other hand, if a company has too much working capital, it may increase costs and reduce profitability because money is not being used efficiently. This article also shows the businesses should manage four important areas, which is cash, inventory, accounts receivable, and accounts payable. For example, companies should monitor inventory regularly, collect payments from customers on time, pay suppliers wisely, and maintain enough cash for daily operation. By following this practice, businesses can improve cash flow, reduce financing costs, lower financial risk, and make better short-term financing decisions. Overall, the article provided practical guidance for financial managers to improve businesses' performance and support long-term sustainability. So, for the conclusion part, this article shows that effective working capital management is very important for improving a company's profitability and financial performance. The study found that maintaining the right amount of working capital help businesses achieve a balance between liquidity and profitability. However, having either too much or too little working capital can negatively affect businesses' operation and financial results. The student also provide useful knowledge for financing managers because it combines research findings with practical business application. Although the study has some limitation and may not represent every industry or country, its findings are still valuable for businesses and future researchers. To conclude, effective working capital management supports better short-term financial decisions, improves business sustainability, and contributes to long organization successfully. Thank you. That is from me.